Once a symbol of global power, the US dollar is now facing an unprecedented wave of decline. Political instability, eroding trust, and the rise of new challengers are quietly redrawing the world's financial order. Has the era of USD dominance come to an end? In today's video, we'll explore the hidden forces reshaping the global economy. Please note, this content is for analysis and education only, and does not reflect any political stance. Let's dive in with an open and objective mindset. The unstoppable decline of the US dollar. In modern history, it has been rare for the US dollar, a symbol of global financial power, to experience a period of such rapid and profound weakening as it has over the past 3 years. The dollar's fall to its lowest level in 3 years was not triggered by typical global economic fluctuations, but rather by a far more alarming internal factor: political instability within the United States itself. Specifically, President Donald Trump's persistent and public attacks on Jerome Powell, chairman of the U.S. Federal Reserve, triggered a chain reaction of negative sentiment in international markets. In a global financial system that relies heavily on trust, the Federal Reserve plays a central role as an independent institution tasked with objectively setting monetary policy, ensuring price stability, promoting sustainable growth, and upholding the U.S. dollar's status as the world's leading reserve currency. A sitting president publicly criticizing, pressuring, and even threatening the Fed's independence has shaken these fundamental principles, sending a signal that U.S. monetary policy could be manipulated for short-term political gains rather than serving as a long-term economic anchor. What do you think? Does the dollar need a multivitamin boost to get back in shape? Drop your thoughts in the comments. I'm already putting together an emergency prescription. The loss of the US dollar's global power. The US dollar is not only losing value in the market, but is also facing a strategic challenge: the decline of its role as the world's primary reserve currency. Over 20 countries, including major economies and developing nations, are actively seeking to reduce their reliance on the USD in international payments and transactions. This marks a historic turning point. Since the end of World War II, the dollar has been the backbone of the global financial system. However, the United States' exploitation of this role, through economic sanctions, unilateral tariff policies, and the use of the USD as a geopolitical weapon, has left many nations feeling both vulnerable and dependent. Reducing the use of the USD is not merely a financial risk mitigation strategy. It also reflects a deeper aspiration for a new financial order where power is no longer concentrated in a single country. From my perspective, this development is pivotal. It is not simply a technical adjustment in global trade, but a sign of systemic weakening in the world order established by the United States. Once systemic trust in the USD erodes, the consequences will reach beyond America, causing shifts in the global financial architecture and paving the way for the rise of other currencies such as the Chinese yuan, the euro, or even new payment systems outside US control. The Trump era's impact. Since Donald Trump took office, the US dollar's value has steadily declined, losing about 12% against major currencies. However, the damage extends far beyond physical devaluation. More seriously, it lies in the erosion of credibility, an intangible but critically important asset of the US economy. Trump implemented a series of America First policies aimed at protecting national interests through aggressive measures, such as imposing tariffs, renegotiating trade agreements, and using the dollar as a tool of pressure. In the short term, some domestic industries may have benefited. Yet, in the long term, these policies have destabilized the liberal trade order that America once championed, ironically, harming the USD the most. What's most concerning is that credibility damage cannot be quickly repaired by simply changing policies. Once the dollar becomes associated with instability and political manipulation, other countries will increasingly seek to diversify their reserves, reduce their use of the USD, and promote alternative options, creating a downward spiral that America will find extremely difficult to reverse in the near future. A new alliance among nations. Amid growing instability in the U.S. economy triggered by the unpredictable policies of the Trump administration, major countries around the world are actively forming new alliances to lessen their economic reliance on the United States. most notably the increasingly close ties among China, Japan, South Korea, Mexico, and Canada. Economies that once had deep trade relations with the U.S. reflect a strategic move to seek alternative partners and protect their long-term interests. China, facing an escalating trade war with the U.S., has strengthened bilateral trade agreements with Japan and South Korea and advanced its Belt and Road Initiative to expand its financial and trade influence. Japan and South Korea, traditionally U.S. security allies, are also stepping up regional trade with each other and Southeast Asian nations, while participating in agreements like the CPTPP, Comprehensive and Progressive Agreement for Trans-Pacific Partnership, to mitigate risks associated with over-reliance on the U.S. market. Mexico and Canada, traditional NAFTA partners, have also recognized the need to diversify their trade partners following intense pressure during Trump's trade negotiations. Mexico has expanded ties with Europe, China, and Latin America, while Canada has boosted commerce with the European Union through CETA and Asian nations. U.S. companies under siege. Beyond institutional and geopolitical weakening, America's own major corporations, long symbols of the nation's dynamism and innovation, are now suffering significant damage. Tesla, Walmart, and Microsoft are among several major companies grappling with increasingly severe challenges. Tesla, representing technological innovation and clean energy advancement, is facing mounting pressure from financial markets. Political and trade turbulence initiated by the Trump administration has made Tesla, whose global supply chain heavily relies on imported materials, a casualty of tariff barriers. Tesla's stock price has fluctuated violently, with drops of 10%, 20% within weeks, as investors grow wary of the political risks now tied to the brand. Walmart, the world's largest retailer, has also been caught in the turmoil. With a business model heavily dependent on inexpensive goods from China and developing countries, Walmart has been hit directly by rising import costs, while U.S. consumer purchasing power has weakened due to inflation. Faced with shrinking profit margins, supply chain disruptions, and declining consumer demand, Walmart has been forced to cut costs and scale back operations. Microsoft, a leading software and cloud services company, while seemingly less exposed to physical trade, has not been immune. It has been indirectly impacted by global investment slowdowns and rising corporate risk aversion. Policy uncertainty regarding immigration, technology regulation, and corporate taxation has also eroded Microsoft's international competitiveness. Risk of recession and unemployment. As the U.S. dollar weakens and global confidence in the American economy wavers, serious consequences are now becoming evident at the domestic level. Uncontrolled inflation, mounting cost pressures on households, and the looming risk of the U.S. economy falling into recession as early as this summer. Recent data show that inflation in the United States has reached its highest level in decades, directly eroding household purchasing power. Prices for food, energy, housing, healthcare, and education have all surged sharply, while real wages have failed to keep pace. American consumers, who drive about 70% of the country's GDP, are increasingly being exhausted by soaring living costs. The instability in consumer spending has severe repercussions for businesses. As demand declines, companies are forced to cut production, lay off workers, or shut down branches, creating a vicious cycle of economic contraction, rising unemployment, reduced consumption, and deeper recession. Economists have warned that this summer could be a critical tipping point, with unemployment indicators expected to spike and official signs of recession likely to be confirmed. From an analytical perspective, I see the U.S. facing a policy dilemma. If the Federal Reserve continues to raise interest rates to curb inflation, it will stifle growth and plunge the economy into a deeper recession. If the Fed halts rate hikes or eases policy, inflation will spiral even further, destroying purchasing power and eroding trust in the dollar. Decline in tourism to the U.S. States cheaper for international tourists, reality paints a very different picture. The number of international visitors to the U.S. is plummeting, triggering a severe crisis in the aviation and hospitality industries. Under normal circumstances, a weaker USD would boost tourism by increasing the purchasing power of foreign visitors. However, the current situation shows that pure economic factors are no longer sufficient to attract tourists. Political instability, strict immigration policies, security concerns, and the deteriorating international image of the United States under Trump have led many to opt for safer, friendlier destinations. Airlines dependent on international travelers, particularly those operating transatlantic and transpacific routes, have seen sharp revenue declines. Many routes have had to reduce frequency or be canceled altogether. Similarly, major hotel chains and resorts, heavily reliant on high-spending international guests, are facing unprecedented financial pressure with falling occupancy rates and declining revenue per room. Trade tensions and budget deficit. The U.S. economy is facing a critical double blow: the prolonged trade war and an escalating budget deficit. The trade conflict, particularly with China, has inflicted widespread damage across key industries such as agriculture, manufacturing, technology, and retail. Businesses are grappling with rising production costs, disrupted supply chains, and the loss of vital export markets, all of which have led to shrinking profits and reduced demand for labor. Meanwhile, the federal budget deficit has ballooned to record levels. Trump's large-scale tax cuts may have stimulated short-term consumption, but they have significantly weakened government revenues, even as public spending continues to surge. This fiscal imbalance has elevated the national debt and increased borrowing costs, leaving America's financial foundation more vulnerable to external shocks. The move away from the USD. A growing number of countries, particularly emerging economies, are actively reducing their reliance on the US dollar in international trade and finance. Concerns over political risks, the weaponization of the dollar through sanctions, and America's rising fiscal instability have accelerated this trend. Nations like China, Russia, India, Turkey, and Brazil are developing alternative payment systems, promoting the use of local currencies in trade agreements, and increasing their reserves of gold and other currencies like the euro and yuan. For developing countries, this shift offers greater financial sovereignty, lowers transaction costs, and minimizes exposure to U.S. economic pressures. From my perspective, as these alternative systems expand, the dollar's dominance will continue to erode. In the long term, this will lead to a more decentralized global financial order, where the United States is no longer the sole financial center, but one among several competing powers. Impact on consumer prices. With a weaker USD, economic theory suggests that American goods and services should become more competitive in international markets. In practice, products like iPhones, Netflix services, Amazon goods, and many US-made items have indeed become cheaper for foreign consumers. At first glance, this seems like good news for American exporters. However, a paradox is unfolding within the US itself. Domestic consumer confidence is sharply declining. Americans facing high inflation, rising living costs, and economic uncertainty are becoming increasingly cautious in their spending. Despite the theoretical affordability of goods, consumers are prioritizing saving over shopping, worried about future income and employment prospects amid a shaky economy. From a personal perspective, I believe that cheaper American goods create only a superficial positive effect and are insufficient to revive the economy if consumer sentiment remains pessimistic. Amid high inflation and unstable incomes, Americans are prioritizing saving over spending, reflecting deep concerns about their financial futures. This highlights that sustainable economic recovery cannot rely solely on exports, but must be anchored in restoring domestic confidence. If this trend persists, the U.S. risks entering a prolonged period of weak growth, despite temporary advantages from favorable exchange rates. The rise of the yuan. One of the most important developments today is China's strategy to internationalize the renminbi, RMB. Rather than relying on the US dollar, China has started settling strategic commodities, such as agricultural products and oil in yuan. At the same time, Beijing is expanding RMB-denominated loans to financially struggling nations like Venezuela, Pakistan, Argentina, and several African countries. This strategy not only aims to shield China from U.S. financial sanctions, but also to build a parallel financial system where the yuan plays a central role, partially displacing the dollar. The Belt and Road Initiative has also proven to be an effective tool for promoting RMB-based transactions in overseas infrastructure projects. Other currencies strengthen. As the US dollar weakens, several other strong currencies are rising and consolidating their positions in the international market. The euro, EUR, Japanese yen, JPY, Swiss franc, CHF, and even the Mexican peso, MXN, have all recorded significant gains against the dollar recently. The euro, backed by the vast European Union economy and more stable monetary policies, has become a reliable alternative for international transactions and foreign reserves. The Japanese yen, long regarded as a safe haven asset during turbulent times, has attracted substantial capital inflows. The Swiss franc, with Switzerland's tradition of neutrality and a solid financial system, continues to draw investors seeking safety. More notably, the Mexican peso, typically vulnerable to market volatility, has strengthened, supported by rising oil and silver prices, and Mexico's deliberate strategy to reduce dependence on the USD. China's new payment system. A core part of China's geopolitical ambition is the promotion of independent international payment systems that bypass the US dollar. Beijing has invested heavily in building the cross-border interbank payment system, CIPS, as an alternative to the traditional SWIFT system, which is controlled by the US and Europe. CIPS enables banks to conduct international financial transactions in Chinese yuan, reducing dependence on the USD while shielding transactions from the risk of US blockades or sanctions. China is also actively promoting the signing of bilateral currency swap agreements with dozens of countries, allowing bilateral trade to take place without routing through the US dollar. Is China building its own financial express lane while the rest of us are stuck in traffic? Let me know what you think. No tolls for leaving a comment. Consequences for American consumers. The weakening of the US dollar, combined with protectionist tariff policies and prolonged trade tensions, has led to a series of negative impacts on the everyday lives of American consumers. The prices of imported goods, an integral part of daily consumer baskets, have surged sharply in recent months. Popular and once easily accessible products like French wine, Mexican avocados, Colombian coffee, and Japanese electronics have all seen significant price increases. Not only luxury items, but also essential goods such as food, clothing, and household products have been directly affected by the weaker dollar and rising import costs. As prices rise while average incomes fail to keep pace, the purchasing power of American consumers has been eroded, forcing them to tighten their budgets and change their shopping habits. Many middle-class households, traditionally the main engine of U.S. consumer spending, are now facing difficult choices in their daily expenditures. The shrinking of living standards not only reduces overall citizen satisfaction, but also carries broader implications for the economy, as domestic consumption, accounting for nearly 70% of U.S. GDP, begins to weaken. Claudia Sheinbaum's policies in Mexico. Under President Claudia Sheinbaum, Mexico is pursuing a strategy to reduce dependence on the U.S. market and dollar. In response to trade tensions and economic risks from Washington, Mexico is expanding exports to Europe, Asia, and South America, while encouraging businesses to use the peso or other currencies in international trade. This reflects a long-term vision of building a more autonomous economy resilient to external shocks. From my perspective, in a multipolar world, Sheinbaum's approach is necessary. If successful, Mexico could become a stronger, independent economic force in Latin America and beyond. The US dollar, losing its role as the world's reserve currency. For more than half a century, the US dollar has served as the central pillar of the global financial system, not only as the primary currency for international trade, but also as the principal reserve asset for central banks and international financial institutions. However, recent economic volatility and the weakening of global trust in the United States are marking the end of the dollar's era of dominance. Major nations and many emerging economies are actively shifting their foreign reserves and trade settlements to other currencies, most notably the Chinese yuan, the euro, the Japanese yen, and even their own domestic currencies. China's push to use the yuan for transactions involving oil, agricultural products, and bilateral trade agreements is one prominent example. Countries like Russia, Iran, India, and many nations within the BRICS bloc are also increasing their gold reserves while reducing their holdings of US dollars in their national reserves. The deeper reasons behind these moves are not just a desire to escape Washington's economic influence, but growing concerns over the long-term stability of the dollar, especially as the US continues to expand its public debt and adopt increasingly unpredictable fiscal and monetary policies. Multinational corporations move capital away from the US. Rising economic instability and growing financial risks in the United States have compelled many multinational corporations, long seen as symbols of American corporate power, to rethink their global asset allocation and investment strategies. Increasingly, major companies are choosing to shift significant portions of their assets, production facilities, and investments to more stable markets in Europe and Asia. Notably, leading technology, manufacturing, and financial firms are rapidly expanding their research centers, production bases, and regional offices in Germany, France, Japan, South Korea, Singapore, as well as in emerging financial hubs like Dubai and Kuala Lumpur. The motivation is not solely operational costs or market size, but also a desire to mitigate risks associated with being overly dependent on the U.S. economy during this period of uncertainty. Global trust in the U.S. economy declines. One of the most dangerous consequences of the political, economic, and trade instability under the Trump administration has been the severe erosion of global trust in the United States. Erratic and unpredictable foreign and economic policies, ranging from widespread import tariffs, withdrawal from international trade agreements, to attacks on financial institutions like the Federal Reserve, have prompted traditional partners, from European allies to Asian trade partners, to reconsider their cooperation strategies with the U.S. The trend toward de-Americanization in global trade is now more evident than ever. Countries are actively signing trade agreements without U.S. involvement, promoting bilateral settlements in local currencies, and developing independent financial networks to minimize reliance on the dollar. No longer viewing the U.S. as a reliable guarantor of free trade and global economic stability, many nations have begun building their own mechanisms of cooperation to protect themselves against sudden shifts from Washington. The weakening of the U.S. dollar is no longer a theory. It's a reality unfolding before our eyes. In my view, this is not just an economic adjustment, but a sign of a profound global power shift that will be difficult to reverse unless the U.S. undertakes bold reforms and regains international trust. What do you think? Can the dollar reclaim its dominance, or are we witnessing the unstoppable rise of a multipolar financial world? Share your thoughts in the comments. Thank you for watching. If you found this content helpful, don't forget to like, share, and subscribe to support us in delivering more neutral and realistic analyses. We look forward to seeing you in the next video.